Hello, everyone. Thank you guys for so much for joining us today. We'll start here momentarily and give everybody time to load up on their computers as always. My name is Dominique, and I am the Investor Relations Manager here at Greenleaf. And I have the investment team here with us today. I have managing partners Dave Kodre and Josh Friedenson, along with Natalie King, who's going to help me drive this live stream. Again, we're going to wait just a couple of minutes or so for everybody to get logged on, and just bear with us, folks, and we'll start here momentarily. Thank you.
Should we get a piece of plexiglass going across right here so we can't move our head around it?
Which like turn off the autofocus. But
Yeah.
Did you guys shoot off any fireworks?
we watched fireworks.
You didn't shoot off any yourself.
A little bit hard to walk down 7 children. It's a light firework.
Plus, every time you launch a firework, they stay up later.
This morning I was backing my car out of the garage, and all 4 of them were on the like I knew they were there before I put the car in here, but like all 4 of them were on the driveway playing behind where I pulled my car. I'm like, how long do I have to sit here?
Traffic jam.
Yeah, exactly. Different game. 6.
All right, we're going to go ahead and get started. For those who just logged on, again, my name is Dominique, and I'm the Investor Relations Manager here at Greenleaf. I have the investment team here with us today. Greenleaf hosts weekly live streams and private Connect events every Thursday at 1 p.m. and 2 p.m. with a new topic every week, highlighting a new portion of our business. Today, we'll be discussing Park Hill and providing updates to the partnership about recent findings and insurance proceeds and whatnot. Before we dive in, we want to provide a quick overview of how to participate in today's live stream today. First and foremost, there is the option to change your presenter view to spotlight view, speaker spotlight view, or feel free to click and drag on your screen to change the size of your presentation on your desktop or computer screen. We are going to have a Q&A portion at the end of this broadcast, so feel free to use the Q&A button at the bottom of your screen. You do not need to wait to share any questions you may have at the end or during this session. Feel free to use that feature and submit any of your questions throughout the duration of this program. This is a reminder that this live stream is recorded, and we will be sure to share the recording with you by the end of the week. All right. So a brief overview of what to expect. First, we will discuss some key players. We'll discuss Fannie Mae's decisions, discuss a opportunity analysis, and then we will go ahead and break out into a question and answer portion at the end of this presentation. So without further ado, I'm going to pass it over to our panelists.
All right, thank you very much, everyone. So to kind of kick things off, we just want to go through who's actually involved in the decision process here. So everyone on this call is a L022 or Park Hill investor. And the other part of this is Capital One. They're our DUS lender. So DUS lender is essentially a delegated person to underwrite or provide a loan that's going to be sold then to Fannie Mae. So Fannie Mae doesn't do stuff directly. We're always going through someone who has that license with Fannie Mae. In this case, it's Capital One. Many of you are in a lot of our other deals. We talk about CBRE a lot as well. We use them for essentially the same function. Capital One does our larger balance loans. And then ultimately Fannie Mae, who they're holding the note. So that's who has it. So I'd like to just kind of get started too by going through like, how do we get to the point we're at now, being early July. So this fire happened back on December 1st in 2020. When this happened, we sent out a video that had some pictures of what the damage looked like to kind of give an assessment and see where we were. But one day, fire basically took out this whole building, and Danielle and our maintenance team got everyone out. So there were no injuries, thankfully. The only real The only real damage was the building. As you can see, the roof basically fully caved in here. By December 7th, our insurance company was out there along with code enforcement, really telling us that there's no way they were going to allow us to rebuild this building based on the damage that had occurred. Follow up just before the end of the month, December 23rd, we got our rough cost estimates back for about $1 million of rebuild cost. And that was really kind of the negotiation starting point with the insurance company. And then by March 15th, so really the whole first quarter of 2021, we got our demo permits and performed the demolition of building D. So it's now it's just a green space with some bushes on it. And that brings us all the way up to today. This is essentially the second quarter. In that time frame, Fannie Mae made their final determination from demo through like, what are we going to do with the insurance proceeds? And we just received that answer this week on their plans for everything. So overall, this process took 7 months. It felt long simply because we didn't know what the end date was going to look like. We've had other fires that were a lot quicker. Some of you were around for third deal.
Yeah.
That one burned down the second day we bought it, I think, but that was a little bit quicker. And Rosecroft was another one that one took quite a while to go through the city and insurance part. That took up to, I think, about 2 years.
Yeah.
So 7 months is not bad, although we do understand, like, we want to make decisions and move this stuff forwards. So what happens now to our cash? That's kind of the point we're at right now. Ultimately, Fannie Mae's decision was that the insurance payout was going to be used to demolish the building and then pay down any outstanding principal on the loan. So the net amount we got from insurance was $839,000. This is net of depreciation, and it's net of our $10,000 deductible on the loan. So essentially, they gave us $105,000 per unit. So we're pretty happy with that amount. $744,000 was used to pay down the loan. There's $25,000 that's held in escrow to kind of finalize that green space area, and our demolition ended up costing us $70,000. The last part of the bottom isn't a joke. Fannie Mae is going to be sending us a check for $151. That's the net left over from this amount. But the real benefit here comes with this loan pay down, the $744,000. And as we go through kind of what that means on the balance, we'll look at the equity component that we're at right now. You want to go through kind of like our market value, kind of how we think about this?
Yeah, so you know, the apartments have done very well in this market. Most apartment deals are trading around a 3.5% cap rate. And so that puts Park Hill's value a little bit just under $25 million or $121,000 a unit. We have about 1.9 million of equity left in the deal, and our debt remaining on the deal after that deduction that we just got is about 5.9 million. So we have about just under $17 million of value left in this deal beyond the equity and the debt. That basically we have a decision to make on what we want to do. Now that basically we're in this position that our debt is really low relative to the value of the deal. It was low, but now with that additional $800,000 pay down, it really marks it down. And our loan is coming up for expiration in the next 24 months, so our prepay is down to really a minimal, down to 1%. So the window's open, debt's super cheap, cash flows are rising that we're going to go through here in a minute. So that's what we want to walk you guys through on kind of our decision making.
Yeah, so the benefit, this insurance proceeds that we received, they allowed us to apply all of it to debt pay down. We didn't have to pay a yield maintenance. We didn't have to pay any fee. We just applied everything to that principal pay down, which when we go to do a refinance saves us money on, I don't think we've done a refinance where we didn't have some kind of prepayment fee.
Exactly.
Right. Like we're always paying some kind of prepayment fee. Josh and I don't like paying fees any more than anyone else does here. So we always try and do our best to not be paying fees. We're not always that successful. There's always something. But with this prepay down from the insurance proceeds, we saved a little bit on that. So we're happy about that, which is good. All right, so let's look at the opportunity that we're seeing with the rates, right? So rates, if anyone's watching the 10-year today, you may or may not be sitting at your computer watching the 10-year on a daily basis, like Josh is. Some of you might have other hobbies, but Josh he really likes that hobby. So right now, we're looking at about 4.5% is what our loan is currently. And even with the rates further down today.
Yeah, so in general, we're getting a new loan, depending on where the market is, most of our loan rates or interest rates are tied to the 10-year treasury and a spread on that. Right now, spreads are usually between 210 and 230 basis points over the 10-year. So the 10-year being at barely 1.25, give or take right now, that would put our new loan, really in the low threes, which is, call it over 100 basis points lower than we currently are. On millions of dollars, we see quite a bit of money. There'll be much more technical analysis once we get our the data on where the actual rate's going to land.
Right. Yeah. We don't get that rate lock until we really have a full term sheet from Capital One, which is getting it from Fannie Mae. But our current numbers, our trailing six, our T6 is $453,000 of net income, which can support about $13 million in debt. That's how we see it. And that keeps us at a 1.25 debt coverage ratio. And that's really that's the max amount that we can get based on the current financials and the current debt coverage ratio. If you've noticed on other loans we had this COVID reserve
right,
where they took a full year of payments. That has now gone away. So there's no holdbacks from COVID, which is positive.
And because we're already with Fannie Mae, we do an annual inspection with them every year. So the property's been well maintained. We don't expect to see a large improvement holdback on their behalf or any kind of fire safety or any kind of holdback, because we get inspected by them every year, and it's the same dust lender and the same lender at the end of the day. They're doing the same reports.
Yeah, it's interesting. We go through all this with Fannie Mae and with Capital One, and then the refinances with Capital One and Fannie Mae. And even when we started going through that, I asked them, I was like, "Are you guys sure that makes sense?" And everyone's fine with that on the Capital One and Fannie Mae side. So we're going to just kind of proceed down that path is what we're looking at here with the same players that are already in the deal because they know the most about it.
Yes.
So if we look at how is this deal operating? So we had a fire, we lost 8 units. We're now a 205 unit complex versus 213. But if we look at the first 6 months of 2021, revenues are up almost 7.5% over 2020. In the very beginning of COVID, we were sending out kind of like hey, here's how things are doing. And Josh and I are obviously nervous at first, and then we saw our collections. Our collections were up during COVID. We're not always the greatest predictors of things, but so that was positive. So the first 6 months of 2020 were good. And now 2021 with 8 less units and revenues are up even more. If we break that down to a per unit basis, our average rents now are $845 versus $769 at the same time last year. So real rates are up about 10% year over year. And we know that we don't have any heavy capital investment needs that have to be done here.
Right.
We actually just did some parking lot improvements that you'll see on the statements in Q2. But other than that, we don't really have anything that's floating out there. So let's jump into what, if we look to hold this thing, we look to refinance it with our loan. The loan comes due December 23rd of 2023, which is that's only 18 months away, 17 months soon. So it's normally we don't like to get to the point where we're a year out before we start a refinance process. We had a 7-year loan on.
Yeah, we did a 7-year.
So we did a 7-year loan on this one, and it's coming up now.
Right.
So you won't go through.
Yeah, so what we're proposing here is a $13 million new loan. After paying down the old loan, roughly 5.9, there'll be some closing costs, 1% prepay that we talked about. We have to do all the same third-party reports and all that. So that's just a rough estimate of what closing costs would be. We'll have about $6.6 million left over. And the way we'll distribute that money is we don't expect any kind of capital improvement holdback. If there is, after inspections, then that would fall in that category. We would pay back all existing equity, all owed prefs, and we would still have about $4.5 million to return to investors after all that. So we see this as being a phenomenal opportunity to hold an asset with at an incredibly low interest rate, locked in for 10 years, and have that inflationary protection because we're seeing rents grow, like they've just said, 9.8% year over year. We're not really seeing any slowdown of that right now, and we expect it to run for the next couple of years.
Yeah, at 865. We're at a very good price point. It's hard to find apartments for less than $1,000 now. So 865 is, we're in a good spot for future rental growth too. If we look at our owed prefs here, when we had the fire, we didn't mention this earlier, but when we had the fire, we didn't do distributions in Q1 and Q2 because we're just uncertain of what the cash picture was going to look like, and if we're going to have outlays that were unplanned. So, like I said, I mean, the property performed well during the 6 months, so we still have cash to pay those prefs as well. So we're in a very good cash position. We'd be able to pay the full loan that we could max out, and we'd have a nice chunk of tax-free cash to distribute.
Yes.
So that is what we're working on right now. Question-wise, every time we go into refinance, we're normally sharing what our specific term sheet and details look like as we get to that point. We're very much on the front end of that, so we don't have those answers right now. But we're going to kind of go into like what our timeline here is for that.
But on general terms, we're usually expect the best pricing with a 10-year loan versus a 5-year loan. We also we generally get 3 to 5 years of interest only, so that will definitely juice our cash flow in that time window.
Yeah.
The amortization is always 30 years, and everything else we plan to be pretty consistent.
Our debt coverage ratio that we spoke about, 1.25, is on a fully amortizing loan. It's not on an interest-only loan, right? So, but I don't think they're going to switch and start doing debt service coverage ratio based on interest only. But then you never know,
right?
So some dates that are coming up here. The principal payment was fully applied on July 7th. So we're going to see a reduction in our monthly interest from that. We still have the full loan payment, so that's not changing. We're hoping to get all of our stuff so we can have this submitted in July. So that's not just like we call Fannie Mae and they say, hey, we want a new loan. We've got to get them. We already have all of our financials, but then they redo all the underwriting on Josh and I and our business to make that happen. We're down that path and starting it. We fully should have a package submitted to Fannie Mae by the end of July. And then hopefully in the middle of that, kind of shortly thereafter, is when we kind of lock our rate and then hopefully get this thing closed, kind of looking at early third quarter.
Yep.
We'll obviously go as fast as possible. Rates over the past month have kind of dropped a bunch from 2 to 1.25. Even today, they dropped a good amount. So, we are trying to get that locked in. We like where they're at right now. So that's kind of the picture that we see. We also have some other stuff coming up here just on new deals, and we're kind of doing our webinars and live streams every Thursday. But I want to open up to questions and kind of go through there next. What else do you have for us, Dominique?
Well, really, we want to provide an overview of our Greenleaf Connect schedule, which are every Thursday, again, those private Connect events as well as those live streams. Next week, we have a QOZ fund update along with Oak Hollow property update as well. And then we do have a couple of deals within the pipeline, so be on the lookout for our new deal live streams that will be shared with you via email along with Zoom link details and everything you really need to know on how to join and be in the know of our new deal launches. And then to close out second quarter, August 5th, we do have our residential and commercial partner review live streams available. So go ahead and mark your calendars. Those will be shared with you upon the announcement of second quarter. And that really closes out our Greenleaf Connect schedule for the next month or so. Right now, we're going to open it up for a question and answer portion. Thank you so much for all who submitted their questions. And I will pass it over to Natalie King to kick this off.
Thank you, Dominique. And again, thank you to everyone who submitted questions. We had a few come through, so we'll start working through those. So the first question we have is, why are we using the same lender or servicer after not being able to do what we wanted to with the insurance proceeds?
So it's a good question. And it was definitely frustrating, but the servicer doesn't necessarily control the decision of Fannie Mae. They're more our representative to Fannie Mae. So we've had a good relationship with them. They've done a bunch of deals with us. So we still feel confident that Capital One can do a good job in representing us and getting the loan through with Fannie Mae. The decision on Fannie Mae's standpoint of why they said, hey, we can't hold the cash versus applying it to the loan, We don't really have a lot of insight into why they made that decision. So, and I don't think it was something that Capital One did to negatively impact that. But in the short term, the fact that we are paying off the loan and avoiding prepay, it's kind of a hidden bonus.
Why don't we wait to closer to when the loan expires to refinance to save on prepayment costs and high closing costs right now?
So the prepayment cost doesn't go away at the end of the loan. So we still have to, there's still a fee to essentially pay the balloon balance of the loan. And it would have been, it would be a little bit lower if we waited another 18 months, but also, I think we just get uncomfortable once we're within that, like, hey, the loan's going to mature in 12 months. That's a little too close for comfort for Josh and I. We prefer to get the process started ahead of that.
Yeah, and the other part is, we have not been great predictors of interest rates. We perpetually think they're going up. But when they are low, we want to lock as much debt as we can, and we feel confident that this is a very low point of interest rates for the time being. So as much confidence as that is, we want to lock it in.
Okay, well, those are all the questions that we have for today. And we thank everyone for submitting those questions. And of course, we want to thank our hosts, Dave and Josh, for sharing these Park Hill updates with us. As we wrap this up, just a friendly reminder of our upcoming live stream schedule. Dominique will put that back on the screen for us. And be sure to check out our Greenleaf Connect YouTube channel for all of our recorded live streams. And this recording will be made available, like Dominique said, by the end of the week. This concludes our Park Hill live stream. We certainly appreciate you joining us today, and we look forward to having you join us on our upcoming live streams. Thanks so much and enjoy your day.
Thanks, everyone. See you later. It's interesting to see how quickly we can get through
The loan.
the full package too. Like, what are their term sheet actually?
Yeah.
Give us the term